Hi everyone, and welcome to today's presentation, Evaluating Some Professional Trading Rules. I want to start off tonight, I rarely do this, but I want to just start off kind of introducing myself a little bit. There are always new people at DTS, and a lot of you come to these events, so I just want to say hi to you and take a minute to tell you about me. For those of you who know me already, you can go refill your beverage or whatever you want. But assuming you don't know me, I am somebody who was never in the market, so I've never been a market maker or market professional of any kind. I did other things, had a business, sold it, looking for something to do. This is 23 years ago or so, and got interested in the market even though I had never been involved in the market, never even actually owned a stock other than what I had through a company. And got interested in it and started to self-teach myself, and I started off just doing options, and this is in the very end of the 90s then. And I was doing okay for a couple 3 months. Still did okay, but then a day came for me where I had a big decision to make. I'll make the story real quick, but basically I came to realize I didn't really know what I was doing. I went through, there's a book out there called How I Made $2 Million in the Stock Market or something by Darvis. And it's a fun book to read because it's the process that I think everybody goes through. I start off like everyone else and listening to TV shows and looking at fundamentals, and I had this stack of magazines on my desk and looking at all the stock picks. And the difference that I think that I was, that maybe not everybody is that I'm very, I don't know, number oriented and just very, show me the proof type of thing. And, I came to realize that I went through the five magazines, and did their best picks of the year, and realized that at the end of 6 months, I looked at them, that they were net break even or just down here. Their best picks, the best people in the world picking the best stocks, and they were down. No particular reason. It wasn't a weird market. They just weren't making money. People on TV, if you really listen to them, they don't have a clue what they're talking about. So I continued on, and basically, make a long story short, I started the beginning of an education for me back then. Back then, there really almost was no education. There was very few places and a very simple class, but it got me involved, got me started, and I did a lot of things in terms of setting up my own parameters to self-improve, and continued. And as far as it goes for me, and I think for anybody, I am, if you ask me if I'm more technical or fundamental, most of you know the answer to that question. I'm not 100% technical, I'm 110% technical, 110%, because there is simply no other way to make money in the market for the average 99.99% of the people. It's something I talk about in various events, and I'm not going to go into now. I just want to give you a little introduction to me. So I spent some time at another company, which was actually one of the biggest companies at the time for education. Long story short, 7 years ago, they broke up. I left. I started my own company, Discipline Trading Strategy, 6 years ago, just over 6 years ago, in the seventh year. And the best thing I ever did, I was a little concerned about running my own company, but it really is, pretty simple. I'm enjoying the heck out of it. I just love working with people. So I took a year where I was just trading for myself, and it was phenomenal. I mean, it was the best year I ever had, and I think it's partly because I learned some things, not, dealing with other people, not running a room. Kind of came motivated, again, long story short, to come back and share some of this with people. So I started up DTS 6 years ago, and I have a trading room that I operate during the day. You have to pay for that. There's a long-term letter that I didn't start off doing initially, but at the prior company, I had done a similar letter, and I had everybody, some people begging me to start doing that again because it was a good letter. So I picked up doing a long-term letter. There's also a daily market letter, but that's not a real big deal. And then, of course, there's a seminar program with the home study courses for people who want to learn. And for what a lot of people appreciate is I have tons and tons and tons of free information. As a matter of fact, I claim that my site has more useful free information than any site out there, anyone, including any of the big boys, because there's a lot of information out there, but it's not useful. It's not good. It's just stupid, rudimentary definitions that will only get you in trouble. So if you are new to DTS, make sure you check out the free stuff page where most of this information exists. Before I get into it, let me take off on just a little tangent. As a matter of fact, it's going to be the topic of an email. Like I tell you, I have like these little on the computer type post-it notes or little files, and every time I have an idea, I toss it into either possible email, possible next webinar, whatever it is. And the email is going to be about the crap that's out there, which I touch on from time to time. You hear me make fun of it. I stay in my own little world. I'm just me. I spend my time with you guys in the room and what I need to for the seminar students. And I work about a half a week. That's the total time I take doing all this that I do. It's about a half week. So it's fun for me. But I don't at all go out and look what other people are doing or, other educators or other things in the market. So I've never spent any time Googling myself or whatever. By the way, if you want if you're new and you want a good confirmation of me, I believe if you Google me, I don't think you'll find a bad word. I don't think. I did a long time ago when I started DTS, which, try doing that with anybody else that's in this business. I mean, you're not going to find that. So I take that as a supreme compliment that, there's just nothing much bad to say about me because I just simply, the people I help, they really appreciate it. I teach well, I do what I teach what I do. And I think people appreciate that, whatever level you're here. But I was talking to somebody on the phone from way back. We just had a little friendly phone call. Somebody used to know. And he said to me, have you seen all the crap that's out there? I'm like, what are you talking about? He goes, it's the emails. I mean, if you're on social media, whatever, I've never seen so much inundation of people that are selling garbage and teaching garbage and, and it's all the garbage that's out there. So I probably will send an email out at some point, just saying kind of to use your common sense. I mean, I'm sure there's some good people out there that can show you what you want, but there is just a lot. This is the highest scam-filled industry in the world, I think. So you just got to be very careful what you get into, and use common sense, please. Just my final word. There's no magical technical indicator. There's no magical piece of software. There's no magical one strategy that you have to learn to conquer the market in 2024. None of that exists. It's just common sense. Think about it. Okay. Well, yeah, you can trade wherever you want, but that's part of it, Paul. It's like apparently people say, "Oh, come trade crypto. That's where the money." You don't need to trade crypto. I mean, if you want to make money trading, my big thing, again, kind of just introduce myself before I get going tonight, which I do about once every 3 or 4 months. My big thing is just boring trades, right? Boring trades. You need to make money. You need to get something to move from point A to point B in a way that you can manage it and hang on to it and not be scared of it, right? So yeah, people say, oh, crypto is really volatile. It moves a lot. You don't need that. Volatility at some point only hurts you. We need something to move. Yeah, I want it to move nice and boring. If a $30 stock moves 30 cents and I have 3,000 shares, I made $900, right? That's it. That's what you want to do. I don't want to be in something where 100 shares of something and I'm up and down $4,000 every 5 minutes. You can't trade like that. At least I'm telling you that as a fact. You may need to prove that to yourself at some point, right? Anything else I should say to you? Along with the other common sense thing that I want to bring up, I hope most of you understand, and I don't mean to talk demeaningly, but I've been doing this a long time. You can't make money understanding or trying to trade fundamentals or understanding the economy. Save yourself a whole lot of time and a whole lot of headache. And if you want to listen to the news, just being a human being and want to know what's going on, that's great. But please don't think that you can understand fundamentals or the economy by reading garbage on the internet. And I don't mean garbage, I mean some of it's true, but the overwhelming amount of information out there, you have no edge, right? There is no edge for you to read an article that 2.3 million other people just read and then go off and act on that, because whatever you're talking about, the price is adjusted a long time ago. So you have to have an edge, and to me, the only edge out there, and when I say to me, I mean, I don't think there's any other answer, period, is understanding how to read a chart, because that is the synthesis of all information out there. It's not to say that fundamentals are wrong or that the economy's wrong. What it is to say is that everybody's digested it, and here's where they put their money down. And that's what we want to follow to make money, period. All right? All right, so let's get going for tonight. And hopefully I didn't take up too much time with a little introduction to myself. If you ever want to email me or chat with me, my email is paul@disciplinetradingstrategies.com. And here it is, so you can just click on it if you want to. If you have a question, if you want to get together for a few minutes and ask me about whatever, stocks that you have, whatever it is. I have plenty of time most every day, particularly after 11 o'clock in the morning Eastern time. Some days I take off and go to the beach or do some other stuff, but some days I hang around and do some other work I do. So, all right, let's get going for tonight. Evaluating some professional trading rules. If you're wondering about how nice that title sounds, this is a very nice sounding title, isn't it? I was thinking a closer look at some professional rules. I was thinking of calling it. You saw this. That's what was emailed to you. I was thinking of calling it professional rules I contradict every day. But the sarcasm there was maybe something that turned people off, even though normally I don't care about turning people off with sarcasm. But these are rules. These are rules that you run into when you start. They often stick with you. If not at a conscious level, then at a subconscious level. Now, where do I get some of these ideas? Where do I have the right to say something like that at a subconscious level? Well, the reason I have a right to is because I have a unique perspective in that I know not only me growing up as a trader, but I know hundreds and hundreds and hundreds of other people who have come to me with questions, problems, charts, trading plans, just people that are not part of the non-paying people. I've talked to hundreds and hundreds and hundreds of people who just have questions like I offered you to ask me. And then, of course, I work with my seminar students. And doing all this gives me a unique perspective in terms of what people think. And a lot of it is very relatable to me because it's probably things that I thought as well. And at some level, people get things in their head and they just get them at some level and it's hard to shake them. And when I ask why they did something on a chart, they'll say blah, blah, blah. And I'm like, well, where did you learn that? Where did you get that idea? And a lot of these things are things that are taught. What I want you to keep in mind is, when you read some rule or something is, who said that? It's really an obvious thing you have to think about anything you read today on the internet, whatever topic you're on, anything in the world. Who said that? That's just some person that you don't know the person. You don't know what experience, background they have. It's great if you read something and through your own independent thought process, you say, wow, that's really good. Let me run with that. But to just read something and believe it because that person said it is very wrong. You can't do that anymore. And a lot of these things is what they are. They're things that are said by people that, quite honestly, I can tell you somebody who knows how to trade and somebody who doesn't by what they say. Because there are a bunch of sayings, rules, expressions, and we're going to go over 5 of them today, that people that say this, they don't really know how to trade. They're not really trading. Because if you really knew what you were doing, you understand that you're just scratching the surface of a topic. And that topic goes much deeper. And to follow your rule will cause you to lose money because you don't really understand what you're saying. I'm not sure if that makes sense or not, but right. So a lot of these things you hear, like with the 5 things we're going to talk about tonight, they sound like common sense, and that's why people glom onto them. But but it's so much about making money trading is not common sense. It's not common sense. Another important thing to remember is that very, very few rules exist in a vacuum. It's very hard to make a blanket statement to say, this is what happens on a chart, blah, blah, blah. It almost always is more involved. There's so many parameters you're dealing with on a chart, so many different things happening, so many moving parts. It's very difficult to ever say anything. As a matter of fact, there's one of my favorite rules I didn't put in today's presentation because it's kind of difficult for me to talk about without going into a whole lot of detail, and it confuses people and it may even give the wrong impression. But there's a lot of rules out there that are just not the right thing. So let's get going with number 1. And a lot of these too I address in other presentations. These are just kind of what I call some of the leftover ones, some of the ones that I've heard a lot lately. Number 1, you must know your target before taking a trade. Before thou enters a trade, thou shalt know thine entry and thy stop and thine target. Otherwise thine target, that doesn't sound very good. Otherwise you will not be entering a trade. And when you really get taught professionally, none of these really are true in a sense. It's a little more dynamic than that, but the least of them all. We eventually do know our entry and our stop, right? Eventually there's a number, you push, boom, there's the entry. And at least the time you enter the trade, you know what you're sizing the stop to. But the target up there, entry, stop, the target up there is always very vague. If it helps any of you, I stink at taking targets. And that's after years and years and years of working at it. If it helps any of you, it's not uncommon for me to hold on to a trade for the home run and have it just go back and give all the profit back. It's not uncommon for me to take a cheap target and have it go 12 times past what my target was. Now, obviously, I get some of them right and do pretty good on some of them, but there is no absolute concept of where a target is. What I always teach people in the seminar program, I teach them is the key is you got to look for the zip code of your potential target. And by the zip code, I don't mean that we need to focus on $32.33. That's ridiculous. Nobody can ever tell you that. What we need to focus on is, hey, I'm getting in here. Am I trying to get back to the high of the day, or to yesterday's high, or to last week's high, or am I in a trade that's going to blow through everything on the chart? That's what you need to do. When you have a trade that has huge potential, you want to kick back and give it the opportunity to get to a bigger type target. Here's the key phrase that really supersedes it all, is that, and it says, think about it. Great management minimizes the need to know exact targets. Think about it. What are you going to do, and I think it's on the next slide, but what are you going to do if you have some target picked and you come up a little short? What are you going to do? You're just going to sit there and look at it? You know, the target is a zip code. It's a general concept of what you want to do, and what takes over for you is management of that target. That's what takes over. What statement I just said is almost an entire course in and of itself. Thanks, Meredith. And that's why the second course of DTS is just all about management, because that's what it is. Eventually, every trader's fate comes down to their management. Everybody will learn at some point reasonable type entries to reasonable concepts that move higher, move lower, where most people end up blowing it. It takes a while to learn that, but there's a huge group that learn that but still struggle because they never manage anything properly. Management supersedes the need to have specific targets in a sense. And it depends a lot how you get there, right? This is the other reason that, you know, and don't get me wrong, I'm not saying you can't have an exact target. I'm just saying that the need, for example, in the trading room, I am constantly updating everybody, and when we enter something, I come up with the exact entry, exact stop. Everybody's given notice, plenty of time generally to get in. I don't even post a target. There is no target I post initially. Why? Well, part of it is on this next one here. Oh, it's going to be it's on the next couple of slides. But the bottom line answer is that the trades I am taking are set up in such a way there always is going to be a reasonable target potential. It doesn't mean I always get it there, but it's going to be a reasonable target potential. It depends how you get there. I just threw this in here from today because it's just a great example, right? Depends how you get there. This was from today. This was TTD. This was short under 85.49. And I ended up having to put a target here, and it was a cheap target. And I thought eventually we would get lower, but we ended up getting here, and I took less than that, which is, you know, not a huge target. But we got here in 2 minutes. Now, I'm not a scalper. Now, maybe some of you that's not a big deal, but I'm not a scalper. I mean, I expect to get to targets in, sometimes we get there in minutes, but in an hour, 2 hours, all day. That's where I like to get most of these. So I get in something, and boom, it drops to the low of the day in 2 minutes. Guess what? I'm taking some of that period, because why? Well, a lot of times you get a really fast drop. It's only because a lot of stops have run. It's a little shakeout thing, and you may not know the true direction of the stock. You see, that's just what happened. The rest of it came back here and actually stopped. I was away from the screen, so this stopped out, or I wouldn't have stopped this out. So by taking a target, it ends up being a small loss rather than a full loss in this case. And you know what? That's a good thing. If the trade ends up not working and you were smart enough to see how to take a target, you get something out of it at least. So this is just how you get there. Now, if we would have bled lower, let's say, all afternoon, and ended up like this, I would not have taken this as a target, because that wouldn't have been a target at that point, right? So, because you would have absorbed all the demand from down there and you would have dropped right through this. So, when you really understand support resistance, which very few people do, support is not just a function of what's there, it's how you get there. Because support means allegedly there's buyers here. And you could arrive here in a way that I could tell you you've used up all your buyers and there's going to be nothing left there anymore. So I'm saying all these words, and it may be over some of yours heads. It may be over the heads of some of you, but I'm saying all these words and throwing all this stuff out there to get you to kind of understand what all is involved, and to make a simple statement that, you know, oh, you have to have a target and it has to be here or wherever it is. That's not how a professional trader trades. It's not at all. It's more of a dynamic process. Now, yes, you have to have some idea where you're going. Otherwise, you don't know how to size something or where to get in something. But you also have to pick a number if you're going to walk away. Now, I typically walk away And if I walk away and I have a first target, sometimes I just go end of the day, so I don't set a target. But sometimes I'll have a target set. And if you do that, you got to pick something. You got to pick an area you think you like, and you hope you get to it. And you hope you don't come up a few pennies short. But that's all you can do when you walk away on something. And that could apply to even if you're a swing trader or a longer term trader. You may be coming into a target. And maybe it's a 2-week target. And you may be $2 away from it. And you say, boy, hope I get there today, but if you leave the screen or if you're not at the screen because you're at work, all you can do is offer it out there and hope you get there. And then, of course, on your management at some point, you'd probably be, adding some kind of trail to it so you don't give back 3 days worth of profits if that's what you're doing. So we're on number 1 still. You must know your target. No, that's not really a good rule. You don't have to. And any good trader may also see that the move is ending, right? Do you hang on and give back all of your profit because you came up short of the target you picked when you can tell with great odds that your move is over? Now, I put a huge red paragraph there because what I just said there is bordering on teaching you something that is probably the biggest trouble for most traders, and that is to always think this is happening. One of the biggest problem traders have is always just grabbing a target because, oh, the move's over, that's it. There's one red bar, I'm done. I was going to hang on to it for 3 days, but there's a red 5-minute bar, I'm getting out. That's the typical thing people do. That's not what I'm saying to do here at all. But if you can really tell when a move is ending, most people probably can't. Most people get out just because they're profitable. But if you can really tell when a move is ending, that's part of the management process that comes in. And again, it goes back to my thing that great management supersedes the needs to know where your target is exactly. This next one is slightly related to it. Am I on the next one? Yeah. Yeah. Well, yeah, John. At least you're talking. Your debate is how much money you're making. So, I mean, at least you're in kind of a good category. And you know what? You're extremely aware of it. So you'll fix it. That's the problem. A lot of people aren't even aware. Here's one of the rules I hear all the time from the great professionals out there that are teaching something or on the great C+ videos. You must have a 3-to-1 or greater reward to risk. RR means reward to risk, right? Meaning that if you're taking a trade and you're thinking of giving it 50 cents stop, you have to have a $1.50 target in mind, or you cannot take that trade. I just said no, but I'm going to go borderline saying that that's just ignorant. Again, this is the dribble that's said by somebody who's just kind of following a rule somebody said to them and blah, blah, blah. Now, don't get me wrong. There's nothing more that I love than to have a great reward to risk setup laying in front of you there. But again, there are a lot of dynamics going on here. What is important to find is an area on the chart where the potential move compared to that has the potential move compared to the amount of room given in the stop is huge, and that's what you want. You want an area, I call it a moment in time, the birthplace of the trade, where you have this nice little area to work with. And by the way, I believe in using wide stops, big stops for the most part, wider stops so that you don't stop out easy, but yet still be able to have a nice potential move that gives you a good reward to risk. I was going to put there's a video on the free stuff page. It's called I was going to put a slide in here about it, from chart reader to trader investor. It's on the free stuff page it's an older video, but it's in the Hall of Fame section. And it really is great as a supplement to what I'm talking about now, because rather than going for huge risk rewards that are hard to find, when you become a better trader, sometimes it makes sense to increase your risk amount and go for a more manageable target that you can hit. Now, there's different trading styles. One is to use that high reward to risk scenario, and that's great. That's a style. I like that style. But unfortunately, most people kind of combine the worst of two styles. In other words, they take some kind of trade with a really tight stop. They stop out a lot. And then when they get that trade to work, they don't get it to the 3-to-1 target. They come up ridiculously short of it. I see you guys typing. I'm going to come back to your comments in just a minute, right? And my whole style of trading, my whole concept of trading, and those of you that take class with me know, is to find a great setup on a time frame. And then to be able to kind of zoom down and finagle a very accurate but yet tighter type of an entry on a smaller time frame. And if you're doing that, the reward to risk will always be phenomenal. Next slide. Here's another question for you if you're hung up on your reward to risk. What if you had a 90% chance of getting a 1-to-1? I've been talking here for a while. Let me ask this question. I'll come back to your questions here on the screen. Would you take that trade? If you knew with pretty good certainty you had a 90% chance of getting to a 1-to-1 target, would you take that trade? Yeah, stupid question. Of course you would. Of course you would, right? And this gets to this whole concept of expectancy. It's not just your reward to risk, it's how likely can you get there. You could say, oh, I have a 5-to-1 trade set up. Well, gee, that's wonderful. But how often do you get there? What good is a 5-to-1 trade if you get there 1 in 10 times? It loses money, right? So it's a blending of, yeah, I want a nice move, but I also want to be able to get there. And what a lot of people do, they set up this theoretical, 3-to-1, 4-to-1, 5-to-1 trade, but then their Sharpe ratio ends up being 1. Now let me explain what that means. I know a lot of you do know what it means. But before you take a trade, you look at a chart and you say, okay, there's my entry, there's my stop, here's my target. It's a 4-to-1, just like I was taught. There's a 4-to-1 risk reward. What a great trade, right? And then the trade takes off, it starts to go up, it pulls back a little bit, and you get out and you have a 1-to-1 target. And you do that trade after trade after trade. Well, your Sharpe ratio is your after the fact reward to risk, so to speak. In other words, it's what did you actually take compared to what did you actually risk. So if you risk 50 cents and you're going for $2, that's a 4-to-1 theoretical trade, but you take 50 cents. And that's what you find with most big reward to risk traders is that they end up not taking anything close to what they projected. So again, you're doing the worst of both things. You're taking those tight stops and stopping out a lot, and then you're taking cheap targets anyhow. You have to have a plan that works. That plan doesn't work, and I emphasize this because it is the most popular plan traders have. Lope, you never know what the market's going to give you or take away for that matter. Well, Lope, if I may, you may get mad at me for saying this, but that sounds like somebody who is a very damaged management style. You sound like somebody who takes chicken profits because you're in a trade and boom, it goes away for you. The market is part of what you do trading, right? The market is part of your game plan. It's part of your strategy. It's part of what you do, right? I always make fun of myself golfing. A comment like that to me is kind of like me saying I'm a great golfer because I hit the ball pin high every time. Of course, I'm in the next fairway over. I'm one fairway off. But hey, I got the distance right? Well, both need to count. And the same thing when you're trading. You can't just say, oh, I had a good stock, but the market killed me. Well, that's not an excuse. I mean, that's part of what you do. You have to take stocks that are either unique on their own page, or you also have to include the market in your concept in terms of market timing and the market patterns going on, right? So sure, you can have the market take it away from you, but you also can't use that as an excuse to say, oh, the market put in a red bar, I'm going to sell everything I have for a very small profit. I emphasize that because, again, in what I see in working with people, the number one people, once people kind of learn a chart, and there's a lot of people that learn a chart well enough to make money, but they never make money because they do that. They're constantly getting out of things and say, oh, the market put in a red bar, I got to get out of this. Well, I thought you were taking a day trade for 5 hours. Why do you care about one red bar? Now, naturally, your time frame you're on varies a lot, and your trading style varies. You may be a scalp type trader, and you are going to immediately get your stop tight, and you're immediately going to take some profit on the way up. And that's fine if that works for you. There's a scalpy type style where you're going to have a very low Sharpe ratio and a higher batting average because you're not going to ever let anything get away from you. That's one style of trading. It's kind of a hard style sometimes because you're getting lots of little profits, and if you get one wrong, you tend to get a loss that wipes out all of your profits. So you have to be very careful with that stuff. But then there's a style that a lot of people have, which is kind of if you're a day trader, kind of a half day trading style. And don't forget for the bigger picture, if anybody long-term or swing trading, you can't be jumping out of trades on a 5-minute chart that are doing nothing wrong on the hourly or daily chart, right? When you type in your trades or your targets, no, Jim, as I said a minute ago, I don't type in targets at all. Anybody following me has to assume that I'm going for some kind of good target. And I always think my potential target, Jim, is huge. I always think my potential target is 5 or 6 to 1. It doesn't happen a lot, but on a walk-away type thing, it will. And most of my trading style, I'm usually taking something, a quicker third, and then a nice 2/3 and a third walk-away, or sometimes a 2/3 walk-away. And that's where you get the big money typically is on a walk-away. In the last couple of weeks, we haven't seen a lot of those great ones because we're just in a very, very kind of tight market here. All right, what if you have 3 lots first target? Yeah, well, nope, I wasn't answering your question, but I just kind of did. Yes. I think that's a good way of trading. Again, you have to keep track of what you do, but to sell in multiple lots and to take something a little bit earlier, if that relieves the pressure for you, that's great. But then what you need to track, Lope, is track what happens, what would have happened had you kept all the lots. In other words, would you have made most of your money by taking all at target 1, target 2, or target 3? And if you find that you would have made more money on a consistent basis over days and days or weeks and weeks of trades, if you would have made more money all at target 1, well, then you know you're not getting into trades that are really moving that much, right? Or the market's not moving as much. And if you find that target 3 would have been best for all, then maybe you should be skewing back to let some things go and walk away for the day as a day trader, or let things go more as a long-term trader. Yeah, Lope, I never mean to offend, but I do want to speak honestly. And, I see words on the screen and I know where they come from sometimes, I can know how people talk and how they ask and, what they want to do when they're in trades that reflects the past. And there are people that, not you, but I mean, there are people that I can tell they were hurt in the past. They were damaged. They lost a lot of money in an account and they screwed up, and now they're so scared that they will not let anything green go negative, which can be very bad. All right, so we talked about this, boom, boom, boom. Number 3, it's bad trading to ever get back profit. Boy, I catch flack from some people whenever I say this, but again, like a lot of things that I try to discuss, there is no other side to this one. Now, there are different trading styles, absolutely. And one trading style could be to really be tight in controlling your profit and to quickly try to minimize losses and to take quicker moves. It's called scalp trading, and I'm fine with that as long as you're really scalp trading. But understand, if you're scalp trading, if you're going to take a 6-cent profit or something, and you're starting off with maybe a 6-cent stop, and as soon as you move up, you're tightening that stop to 3 cents, and you're getting out of the trade at 6 cents, that's great. But you have to be taking 3,000, 5,000, 10,000 shares at a time. Don't tell me you're taking your 300 shares of Tesla and you're taking a 10-cent profit because you're scalping. That will never work in anybody's book. No way, no how ever. So a true scalp trader, that's great. You're just bringing that time frame down to a 1-minute/tick chart. That's fine. But you still have to follow your rules, whatever that is, right? And for a scalp trader, in other words, maybe the same scenario brought down to a scalp level would be you're taking profits at 2 cents all the time, and then you're taking 4-cent losses, whatever it is. So if you take this literally, it would mean that anytime you have a 1 penny profit, you'd have to sell for a 1 penny profit. So literally, you can't argue that makes any sense, right? But let's go beyond that, and let's just say, okay, here's a question I'll pose to you. Everybody, is it okay to have a full 1 hour profit and let it go to a full loss? In other words, you're risking $500 in a trade, you're up $500, and it goes to a full $500 loss. Is that ever okay? What do you think, yes or no? Maybe the word okay is a bad word. Let me use some other words here. I know nobody likes that, right? I'll put a sad face up here. Nobody likes that. But is it proper? I guess okay is a good word. Is it acceptable if that happens sometimes? I couldn't disagree with that more. I mean, that to me is very bad training. No offense. Your break even is not on the chart anywhere. Your break even number is not on the chart. And you'll probably find that it'll get you in a long pattern of break even type of trading. Yeah, Mark has, I think, the smart answer on here. This absolutely positively has to be okay. It is not wrong in and of itself. I mean, saying it's not wrong to get back 1 hour worth of profits. So it may have been wrong because maybe you didn't handle it right. But listen to me. Listen to this little scenario here real quick, right? You're in a trade, right? You're going for a target up here. The trade runs up somewhere. It pulls back. It stays just above your stop and goes on to hit target 1 and target 2, right? The next day, you're in the same trade. It runs up and it pulls back and it stops you out. You follow that? How do you distinguish these two, right? So if you're saying that that's unacceptable, right? If you're saying that this is unacceptable, did you follow what I just did there, everybody? In other words, kind of two identical setups, but one day you held your stop and it was the trade of the day. The next day it stopped you out. And then you look at this trade and somebody would say to me, I've had this happen to me in the room. This happens to me once in a while. And somebody says that's totally unacceptable to do that. Totally unacceptable to do that. Well, here's my problem. How do you fix that? Anybody who thinks this is unacceptable, how do you fix that? Well, the only way you could fix it is to say, oh, I'll just take profit there. Well, whatever your wider stop is, Bradley, you could still hit it, right? And here's the important point is whatever you do to fix it, think about this, everybody. Whatever you do to fix this so that you took profit there, guess what? This day, you would have taken profit here. You would have got a third of an hour profit and given up 3 hours profit. You see what I'm saying? In other words, this is not the Army. In the Army, we have there's a saying, no good soldiers left behind, right? That's not true in trading. Some things fall through the cracks. In order to save this trade, so to speak, and make money from a trade that you didn't like giving up money on, you may kill 6 other trades. Does that make sense, everybody? In trading, we leave bad soldiers behind. In trading, occasionally a trade will fall through the cracks, right? Does that make sense, everyone? I'll make sure you understand this, because at a free event, I mean, this is gold type of stuff. I mean, it doesn't explain necessarily how to do it, but just the concept. Because if you have some trade you didn't like, and you say, I'm not going to let that happen again, well, you just limited your profit for the rest of your life, right? No matter what you do, no matter what your management rules are, something will fall through the cracks. Okay, can you all agree to that? If you're going to follow a consistent plan, and the goal of that plan is to maximize your profit over X number of trades. In other words, you look at all these trades and you say, what could I have changed to make things better? You have to look at that change being in effect over every single trade, right? Over 20 trades. Does that make sense? That management plan is to work over 20 trades. You can't say, oh, this one trade, I'm going to change it. How do you know? How do you possibly know? Now, if there is something you can identify, you can put that in your plan, right? I have something I put in my plan to help avoid that, and it's called the free money rule, right? If I get in and I have a target and I get more than halfway to my target instantly, I'll take a third off the table. That helps to avoid that. And I just showed you that trade. I just showed you the trade where I did that, right? But you have to follow a rule because you can't customize your management for every trade that you do and look back in hindsight and complain about what you did. It has to be a rule that works for everything. Something will always fall through the cracks. Something will always fall through the cracks, and you just have to let it go. All right, you guys have a lot of comments here. Let me go back here. All right, Mike, you're going to send me some stuff on your 20, 40 ticks. Yeah, right, you're right. Long run is what matters, right? It's not one trade, it's over X number of trades. I told you I don't like your comment about getting stopped to break even. And then you say you can always get back in. No, that's not true, Jim. Let me ask the room something here, everybody. When you get in a trade and you get out of it, what percentage of the time do you get back in the trade? 10 would be a high number for most people, right? It's usually 0 to 10. That's what everybody says, right? It's hard in every way, right? So number one, Jim, it's never going to happen. But number two, let me show you something else. And because, Jim, I teach to do the exact opposite, which is to say you got in a trade in a sense, you've now placed a bet that you're going to get to some area on the chart. And you get there, you don't get there, whatever. When something clearly happens that you can adjust your stop, you do that. But Jim, here's the problem, right? If you're on your way and you're trying to get somewhere, and here comes an entry. So here's your entry, right? You get in here in some kind of uptrend, right? And you do this, right, Jim? And you come back to break even and you get out, right? Well, now you're at 0, but now where's your new entry, Jim? Where's your new entry? If you got out here because you're scared, don't tell me you're getting back in here, right? Your new entry is way up here, right? So now your new trade has an inferior reward to risk because you have a much later entry and a much wider stop. Do you see what I'm saying? So, and this is actually, I have slides in the seminar program about this. It's a fallacy, right? It's kind of more of a chicken way of trading. And break even, I'm sorry, your break even is not on the chart anymore. I mean, I don't understand break even at all. You get in, right? There's your entry. Here's your stop. And you're out. I don't get it. There's nothing about your entry point that shows up on a chart as the support or resistance level. We put our stops or targets at support resistance areas so that we can stay contained in that move. Yeah, Mike, it's the worst saying in the world, right? You can't go broke taking a profit. That's the saying, and I teach that a lot. That's the worst thing in the world you can follow, because it's an excuse to just get out. Fall through the cracks, saving one trade. Right, so saving one trade may cost you many times that on other trades. All right, moving on to number 4. Oh, if you want more on this, there's an event called Tips on Management. It would be on the archive page to the free stuff page. When you're on the free stuff page, you gotta go to the archives. It's back from 19-1120, Tips on Management. It talks about some of these topics. Here's a favorite one that I get accused of sometimes, this would be a day trading concept. It wouldn't really apply because red on the day is the phrase here. Never buy a stock that's red on the day. Boy, you hear that a lot, right? That's down on the day. Don't buy a stock that's down on the day, below its opening price. You're buying garbage, right? Have you ever heard that before? Yeah? It's a very, very common thing people regurgitate to me, right? Have you heard this before? Don't buy a stock that's red on the day. Anybody who says this to you is clueless. I mean completely clueless. And this isn't a matter of discussion. None of these things to me are a matter of discussion. These are just facts from somebody in the trenches trading all the time. And I'm going to show you why. It makes absolutely no sense. So there you go. Here's the open. This is the day break. Here's your stock. It falls for the opening 30 minutes, right? What's that bargain? What's the daily bargain look like, everybody? What's the daily bargain look like? We opened and we fell for 30 minutes. Daily bar is going to be, no, it's not going to be a topping tail. It's going to be a big red bar. So here we are. We've fallen the whole opening half hour, whatever it is. The daily chart is a big red bar, or a red bar. I shouldn't say big. We have no perspective to the other bars here. And somebody say to me, you can't go long here. Can I go long here? Can I go long here? I should say, can I ever go long here? Naturally, you don't see any of the chart to say, can I? You can't say that it's a good trade. The real question is, can I ever go long here? Right, absolutely. This could be the best trade in the world, right? Why? Well, here's the hourly chart. That's what you're looking at. The stock rallies the whole afternoon into the close and pulls back the next morning into minor support, into whatever, blah, 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 whatever you like to see. It's the best trade in the world, but guess what? If we just happen to tick, 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 stop the day here, well, this shows up as a red bar. You'll have a green bar at the end of the day, green bar at the end of the day, and a red bar this day, right? Absolutely, positively, nothing wrong with it. And you can apply a similar logic to another common phrase. I didn't put separate slides in here to address this, but there's a separate concept that says you should never go long a downtrend. That also is not true in a vacuum like that. The concept of buying a downtrend on the time frame you're trading, well, even that depends. There's a lot more to understand than even say that. I do not agree with the comment that you can't go long in a downtrend. I could show you many charts where I would. It depends what's going on. This last one I put on here is kind of a big one, and I'm glad I thought to put it on here because I almost forgot it. But what this is a presentation I made for the website, and it was never an event. I never had an event about how to handle the trading stuff. I think I emailed it to people, I put it on the website. It's not in the prior events section, it's in the educational videos on various topics section. But here is the thing that you hear a lot. And this is you got to listen to me on this one because this is kind of a close call on this one. You may not agree with me initially. If you have a bad losing day, you should immediately reduce your risk until you recover. Let me hear some of your comments on that. True, false, true when, false when. If you have a bad losing day, you should immediately reduce your risk until you recover. What do you think about that? But this is a very common one, and on the surface of it, it does sound pretty good. I even kind of like the sound of it to some degree. I think you'll enjoy this conversation then, Lope, because you can see my writing on the slide even, right? No. Well, a martingale strategy would be you constantly increase your risk, Jim, the more you lose. And if you do that, you'll just be out of business very quickly. So, yeah, well, martingale, right, again, but it's not really the point of this discussion here, Jim. The point of this is that it comes down somewhat to the question of whether or not you're an experienced or not an experienced trader, right? Yeah, that's what I thought, Lope. I had it right. It comes down to a lot if you're a new trader or experienced trader. Now, here's my thing on the new trader. You might say off the top of your head, Paul, a new trader should do that. No, you know what a new trader should do, everybody? Why is this not the right saying for a new trader? And Lope, you're going to love this. No, why is this not? If you have a bad losing day, immediately reduce your risk until you recover. If you're a new trader, meaning you're still in the learning process, why is this not for you? Kind of, Gary. Because, oh, go ahead, everybody's typing. I'll give you guys a second here. You're going to love this answer. Well, I'm assuming that this person is beyond paper trading at this point, John. I mean, they're new, but they're still working their way up. But you're hitting on it, John. It's that as a new trader, you have a very rigid money management policy you're already following, right? This is a very vague statement. What's a bad day? How much do you reduce it, right? As a new trader, if you do not have a rigid money management plan to advance, you're screwed. You're not going to make it, period. So you already have, as a new trader, I'm going to start off risking X dollars. And if I get 4 winning trades in a row, I'll increase to X plus 2, whatever it is, okay? And if I get that money, and if I ever have a day where I lose X dollars, I have to stop the advancement, or I have to go back the next day. Or I don't care about one day, but if I have 2 days in a row, and do you see what I'm saying, everybody? You should have a detailed plan as a new trader that supersedes this ridiculous vague comment. Does that make sense, everybody? And Lope, again, I'm sorry, but you're kind of showing yourself in that you're just kind of out there freewheeling it, right? You're just kind of, well, yeah, that's what I do. Well, the right answer would be, well, I don't really, I do something like that, but I have a plan I follow, and if I lose X amount, I have to back up a step, right? Yeah. Lope, you can't fly by the seat of your pants in trading and make money. I mean, I'm just telling you for your own good, from experience, you can't do that. You have to get serious about what you're doing. Just going out there and just floating in the wind, it's not going to do it. So I don't like this for a new trader, because a new trader should have way beyond that in their plan, right? When you're a new trader, what are you worried about? You're worried about money management. You're worried about improving. You're worried about learning what you're doing, right? And you're monitoring every single day, right? Right, everybody? Absolutely in stone. Well, what about the experienced trader, right? So we're beyond the new trader stage, right? I've been risking X dollars, big dollars, day after day after day, and I'm a good trader. I'm not having any troubles, right? And I have one bad day. Let me ask you this, anybody. Have you ever had, like, you have a bad day because you're risking a fair amount of money, and then you cut back? Let's just say you're risking $500, so I can use the numbers, right? And you have a bad day, and you say, oh man, you know what? Somebody told me I should cut back. So then you go down to $200 the next day, right? And guess what you have? Winning day, winning day, winning day, winning day, right? But you're at 200 risk, right? So then you say, okay, I'll go back to 500. And then you go to 500, what happens? You have a losing day. You go back. Can anybody relate to what I'm just saying? If you're a good trader, you take a hit once in a while. That's what happens, right? But if you're a good trader, you have now again, very fine line here. I'm saying you're a good trader, you have the track record, you know what you're doing, you know what you do, and no other trader in the world will tell you this. But you grab yourself by the butt, you sit back in the chair, you go back the next day like nothing ever happened, you push the button just like you would have the prior day, and you do it all again the next day, and you get it right. Now, if you screw up the next day, now there is one thing you do, of course, right? But this is part of every good trader's procedure. Of course, you review your trades at the end of the day, right? If you did something stupid, you have to fix that or change it or realize it. But I'm just assuming that, hey, nothing worked today, right? Nothing worked. What a crappy day. Nothing worked, right? The next day, you just get back out there and you do what you're supposed to do. I can't tell you how many times I had a bad day, and the next day I just blew right through it and had a great day, right? And if I would have been all scared and cautious and, oh my gosh, what am I doing? You make money through confidence in trading, right? And I've seen it myself some days. There's some days if boy, I did have a tough day and I didn't feel good, right? And all of a sudden, I passed that trade because I don't have the confidence to do what I normally would have done, right? Big 5-minute rally, stock takes off. It's a bearish chart though, and it takes off for 5 minutes. Normally I'd be in there and just short the top of that 5-minute bar, bam. And I don't do it because I'm like, oh man, maybe I would be more careful today. And then what happens is that trade would have made my whole day's profit, and I'm just looking at it, right? Be smart and see if you did something wrong. But if you did nothing wrong, you get back in there and you do what you're supposed to do day after day. Now, again, if you screw up second day, third day, then you got to stop and say, wait a minute. I shouldn't have screwed up 3 days in a row. I'm seeing something wrong. The market's changed, and you got to evaluate then, right? And then you see what you want to do, right? Right. Stats are everything, Mark. I have that somewhere else, but yeah, stats are everything. I don't know if that's on a slide coming up or I'm almost done here. Thanks, John. Well, Lope, I mean, a big question is, I'm so sorry, Lope, but you say trigger words to me. You say trigger words, and I'm so sorry, but I hear these words, and it just did 3 times in a row. I'm working on changing myself. Hey, Lope, you invited me to a party you're having next week, right? Right, Lope? You invited me to a party you're having next week? I'll try to be there. Am I going to be there? Lope, there's no such thing as working on trading yourself. Yeah, but you can't be working on changing yourself. You have to be changing yourself, right? You have to be changing yourself. There's a little difference there. Working on changing yourself is a laid-back, laissez-faire attitude that says, well, I'm just going to keep. What is your plan? What is your plan to change? Why are you going to do something different tomorrow than what you did today? Hey, Lope, in the recording, can I leave your name in? Is that okay? Seriously. But do you see what I'm saying, Lope? It's I pick on little things like this psychologically. There's a commercial for Tunnel to Towers, and Mark Wahlberg is on there, and he says, "I'd like to ask you to donate money." That bothers me because, well, Mark, if you'd like to ask me, why don't you ask me, right? Another person in the same position said, "I want you to donate money." That's the direct statement. And it's kind of a similar thing. I mean, you're thinking about changing yourself. Well, what are you doing? What kind of stats do you have on your trades? Can you tell me how much money you made long or short this week on whatever you're doing? I'll give you the answer. Your answer is no, right? You don't have any stats that you could look back on, correct? So you have no method of, I don't have to ask you, I know you don't. I mean, I don't know you, but I just kind of know. You probably don't, right? Do you have a trading plan? You don't have a trading plan. If you do, it's a trading plan that says, well, I'm going to buy 5-minute uptrends on really nice looking charts that look pretty to me. If you want to change, they'll change. Stop saying you're working on changing. Change. Does that make sense to everybody? I'm saying this to everybody. You trade well from getting confidence from having winning trades with the basis of really knowing what you're doing and starting off with small risk and building into bigger risk. That's how you do it. Well, it depends. I mean, not everybody's ready. I mean, again, I'm not here to, I really am not here to tell you, but obviously, to me, the best thing you can do is take the seminar program. That's where people become successful. But not everybody's ready for that, John, is the problem. I mean, some people are doing other things and can't devote the time. But what I encourage you to do, though, Lope, is until you're able to get training, if you don't like me, get it from somebody you like, some kind of mentor to really teach you what you're doing. But until then, it's not good to just keep pushing the button, doing wrong things and forming bad habits if that's what you're doing, right? So if you're on a program for self-improvement, you have to track what you do, look at it every day and say, okay, what should I have done differently? And then do it the next day. That's the only way you can teach yourself, is through a process of continuously revising and reviewing what you do. Is that right, everybody? Well, there you go, Lopes. I mean, you know this stuff, right? You cannot just trade day after day and just think something's going to get better the next day, right? If you don't have the knowledge database, if you're not making any effort to improve, right? Thanks, Mike. That's a good analogy. And there's the video, Trading Slump, if you want to review that one. I kind of like that one myself, but I just gave it to you for the most part so you can save your time. Everybody, Friday, you're invited to Introduction to Mastering Technical Analysis. If you can make it for this, please do. The day after that, obviously, the seminar program starts. There's never a sale for the seminar program. It's never discounted. It is what it is. I just encourage you, when the time is right, to consider doing it. You'll never, ever regret doing it. There's a lot to learn. It's easy to learn, but you have to be taught what to look at and what to do and how to progress to make money. So this starts the next leg of the seminar program. If you're not ready to sign up, take the introductory class on Friday. It's a great start. By the way, for those of you in the seminar program, the intro class is finally going on to the home study. probably in a couple of weeks. I'm almost done putting that in the home study. Another little improvement to the home study. Most of you probably don't care, but I highly thanks, John. Highly recommend seminar program. And for those of you who are brand new and just sticking your toe in the water here, make sure to check out the free stuff page. As I explained earlier, greatest source of free information, useful free information anywhere on the internet. Any questions from everybody? It's 6:05. I was done on time, I'm going to say, but I was busy giving an additional talk about, to everybody, not just to Lope, about being serious if you really want to do this. I could speak forever on any topic you want about trading, but think about it this way too. Oh, the market is a very expensive teacher, This is another one that always cracks me up. I mean, there are people that lose more money every single month or every 2 weeks than the seminar program costs, but they're stubborn about wanting to get some information. Well, think about it this way. Every day in the New York Stock Exchange, $20 billion changes hands. In worldwide stocks, it's 200 billion. In Forex, it's 6 trillion, right? All that money is changing hands. Involves a lot of people. I don't know how somebody expects they're going to walk up to the marketplace with just a common sense attitude, buy low, sell high, and think that they're going to conquer the market. You can conquer it. I mean, there's some very simple, I don't call them loopholes or just things you can do all over the place, but you kind of have to learn what to do. Think of it this way also. People say 90%, I don't know how you determine the number, but 90% of the people who come to the market fail. Why? Because they all think the same. They all use common sense. You got to think outside the box, right? And that's what learning technical analysis at an A level does. It has you thinking outside the box because you see what actually happens in the market, not what somebody says should be happening, right? Yeah, but Mike, it depends, when they say don't make it, it depends what don't make it means. I mean, if you came to the market for your income and you need to make $60,000 a year and you only made 30, so you had to quit, are you a failure? Did you not make it? Were you unsuccessful? You know what I mean? I don't know where the number comes from, but clearly most people jumping in don't make it, And some people make it for a short time because they're bullish in a bullish market and they just buy anything nilly-willy and they never stop out of anything, but then one day the market corrects and then they're gone. So, it's one thing to even make it for a month, and it's another thing to make it for a year, longevity. Well, Mike, I've never been against self-teaching. It's the purpose for some of the free stuff that I offer, and I've often offered to help people in the process. But there's the key words. You have to do something to self-teach yourself, right? Unfortunately, most people's definition of self-teaching is take a bunch of trades, see that they don't work, and try something different tomorrow. That's their definition of self-teaching. And I hate to be mean, but it's true, right? It's true, everybody. There are very few people that have the discipline to really try to teach themselves. It's a difficult process, Miras, because the only way you can do it is through trial and error. It's a constant trial and error. It's a close tracking of what you do, and it's a constant trial and error thing to say, okay, I'm going to try this didn't work. All right, what if I change my parameters and I enter down here on this pattern? So it's very difficult to me. It's a long process. I think people should get educated. But I know, Mirnis, that 90% of the people think it's a waste of time and money because they can figure it out. Well, I don't want anybody to get hurt trying it, and that's why I think you just paper trade until you can prove whether you can do it or not. But to me, the other thing, Mirnis, is that a much better student comes from somebody who's tried and failed because their mind is now open to the fact that they can't do it. Rather than somebody who comes with this attitude that, well, I'm just going to get a few pointers from you, Paul, because I kind of know what I'm doing, and they don't know what they're doing, and they've been losing money, but they don't admit it, and then they never change to what they should be doing because they hang on to their old methods. Does that make sense, kind of? So because I beat around the bush, let me clearly state it. You would never regret taking the DTS seminar program. It's home study, it's me, it's coaching by me, it's whatever you need to make you successful. But if you can't do that right now or you don't want to, you have to teach yourself. You can't just fumble around and hope things will go okay, because they won't. They never will. I learned more self-teaching because I did research experiment with stats until they worked. That's exactly what I said, Mike. Yeah, that's what you got to do, right? Never miss, and it's helped big time. However, I've learned a good foundation. Good, all right. I need to ask you, how often do you lose +1 or profit? and take a 1 hour loss? Well, most all of my trades that are losses are a full loss. Is that what you're asking, Jim? I'm not a believer in, okay, I'm not a believer in minimizing losses for the purpose of minimizing a loss. Here's another favorite saying of mine, everybody, if you're still here, is that if your goal is to minimize your losses, what will you end up with inevitably at the end of the week or at the end of the month, everybody? If your goal, if that's your stated goal, is to minimize losses, you'll end up with a whole string of minimized losses, right? My goal, Jim, is to make money. And most of the time that means that I've taken a trade and I believe that there's some, I'm going to the slide here, and I believe that there's some entry that should have the stock going higher, and there's some stop that should not be violated, and using those parameters, I should be able to get to where I'm going, right? So my goal is to minimize this loss as soon as I can. Now, something could happen along the way where a new level forms, and I say, you know what? There's no way I want to be under that anymore, or even between my entry and stop. I could have it go down halfway to my stop and blast off, say, hey, you know what? There's my new stop. And it's not because I'm chicken or because I want to save money or it's not because I want to minimize the loss. It's because that under that, it's no longer going to work. So I'll have a lot of times where I'll have a less than a 1 hour loss, but it's not my goal, Jim. It's not my goal. As a matter of fact, I frequently will take more than a 1 hour loss, which is a whole topic I don't want to get into right now, intentionally, right? Death by 1,000 cuts, that's a very popular saying for a lot of people, especially when you minimize losses, yeah. There's nothing wrong with minimizing a loss if the chart says that you should move your stop, right? But the problem, Jim, is that most people don't look to the chart to find an area that says, hey, this is no longer a good trade under this number, right? Rather, they just say, well, I hope this area holds, and if it doesn't, well, now it's a partial loss, and I feel good about that. That's going to be a losing strategy all the time, right? Great, Mike. I look forward to seeing you there. There is so much to learn in general. I mean, I think it could only help to benefit you, and especially somebody with your attitude, Mike, you would just soak this up because that's the attitude you have to have, is to always say it's almost a constant evaluation process to keep on going and always getting better. Goal is to make money. Who said that? Hey, honey, how are you doing? I'm going to take issue with what you said. The goal is to make money using consistent risk every day. I do not want to ever say that my goal is to minimize risk. If it's a byproduct of what happens, that's great. But it's not my goal. My goal is to find a trade that with these parameters, I make it a good part of the way to the target and can take good money. Consistent risk is very important. The goal is to make money. Now, let me add this, Hani, as long as we're talking about all these great topics here. I mean, you could prove to me that minimizing risk works for you in your trading plan, but you have to prove it. In other words, it's not just a matter of, oh, I'm afraid, I don't want that full loss, let me move the stop randomly, right? But what if you could prove that any trade that hiccups a little bit, that if you immediately got your stop up, it is quite possible you could prove over multiple trades that actually does make you money. Because while a couple of trades went on to be winners and you got rid of those, 6 out of 7 do not continue higher. And if you can recognize that area, if you're good at that, especially the more you are kind of a scalp trader, the more you would lean toward minimizing risks and taking smaller targets as part of your plan. But you kind of have to prove it. So I mean, I don't think it's a goal. If it's part of a well thought out and proven trading plan, that's great, right? My point earlier is that you can't self-teach what is taught in the center. Oh, right, Mirnas. Yeah, thank you very much. Mirnas makes a great point. I was arguing, Mirnas, that people who try to teach themselves, will, that's what you have to do. But no, what's in my seminar program, correct. A lot of that is simply not even out there, right? It's not just repeating typical technical analysis stuff, right? Class 2 is not out there on the internet. In Class 1, even though the basics you would recognize, the way I teach it, I think is completely different. Good, Mike. Good. All right. Anything else? I don't, again, I ended basically at 6, and we've had great conversations here, which I didn't expect tonight, so that's great. Enter by rule, size correctly, let the system Exist, take you out of max loss. Yeah. Well, Hani, I agree with that as long as you prove that's the best thing to do. Yes, it's called all or nothing trading, and it's usually the best for most people who know what they're doing, who have a fairly good knowledge of the charts. Naturally, if you pick all losing trades, that's not going to help you much. But I agree with what you said. And you have to prove, though, that on a consistent basis, that is what makes the most money for you, right? All right, thanks, everybody. Have a good night, everybody. If you're in trading, we'll see you in the morning. Otherwise, we'll see you guys Friday for the intro class. Have a good weekend if I don't see you. Take care.